Want to grow your money without gambling it? These three options are where smart money is going in 2025. Let's be honest, most people think investing means risking everything on stocks or crypto. But the truth is, there are smart, low-risk ways to build your wealth steadily. Whether you're just starting or want a safer path, these three investment options are solid bets for 2025 and beyond. First up, high-yield savings accounts and money market funds. They're boring, and that's the point. Right now, interest rates are still elevated compared to previous years, and that means these low-risk vehicles are actually earning real returns. We're seeing APYs between 4 to 5%, sometimes higher, especially with online banks or money market mutual funds. There's zero guesswork. Your principal stays safe. It's FDIC insured in many cases, and your money stays liquid. You can pull it out anytime without penalties. Perfect for your emergency fund or short-term goals. Number 2, government bonds, specifically T-bills and I-bonds. T-bills are ultra-short-term U.S. government securities that currently offer strong returns relative to their risk profile. You can buy them in terms as short as 4 weeks or as long as a year, and they're backed by the U.S. government, so default risk is essentially zero. Now, I-bonds are another interesting option, especially if you're concerned about inflation. These bonds adjust their interest rate every 6 months based on inflation data. While they're capped at $10,000 per person per year, they're a great way to protect your cash from being eroded by rising prices. In 2025, both options are still competitive compared to traditional bank products, and they offer peace of mind for the risk-averse investor. And third, dividend-paying ETFs. These aren't as flashy as tech stocks, but they offer something much more reliable: consistent income. ETFs like Vanguard's High Dividend Yield ETF or Schwab's Dividend Equity ETF give you exposure to a diversified mix of large, stable companies that have a history of paying dividends, even in uncertain markets. They spread risk across hundreds of stocks, and unlike individual companies, you're not relying on a single business to perform. Over time, you can reinvest those dividends to boost your returns through compounding. While they do carry some market risk, they're far more stable than growth stocks, and they're excellent for people looking to slowly build passive income while preserving capital. So let's recap. High-yield savings and money markets for safety and flexibility. T-bills and I-bonds for stable, government-backed returns. Dividend-paying ETFs for slow and steady growth, plus passive income. None of these are going to 10x your money overnight, but that's exactly why they work. Low-risk investing is about consistency, not hype. If you start with any of these in 2025, you're not just playing it safe, you're playing it smart. Don't chase trends. Build wealth that lasts.